Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, March 17, 2017. So this week stocks more or less traded sideways with some pockets of strength and some pockets of weakness, and we'll kind of go over where this is all going. Very surprisingly, bonds of all sorts moved higher despite the increase in federal funds rate. So we'll kind of look at more details at bonds. Additionally, also surprisingly, US dollar moved lower versus the major currencies, but I still think that the long-term trend is up for the US dollar. And the gold and gold miners are taking advantage of the weaker dollar, and they moved higher. We'll look at oil, which is attempting to recover last week's great fall. Same thing with energy, XLE. And we'll look at natural gas, which may or may not be done correcting and may actually still retest 2016 breakout. Alright, let's look at the S&P 500 ETF SPY. And this is a daily time frame with dividends adjusted for dividends. In other words, the prices have been adjusted for dividends. So very close to all-time highs. Very bullish chart still, in my opinion. We had this gap up here. I thought this was an exhaustion gap. We did close this gap, so far looks like we're attempting to make a lower high. If we do make a lower high, maybe we'll get something like this. We got the lower high right there in December of last year, moved slightly higher, lower rather, and then just continued higher. So this is a bullish chart, and I would definitely avoid shorting it for now. We could just continue higher from here. Maybe we'll take a pause and again maybe trade sideways. Maybe we'll pull back slightly and then we'll take another leg higher. But again, I don't think I want to short this chart anytime soon. Market breadth is not showing any major divergences, so far so good. Here's a little bit longer term time frame. Here's market breadth index. This is my proprietary market breadth index for stocks. It is firmly in the bullish territory. It's currently at 5. It's highest possible reading. The percentage of stocks in the uptrend, also another proprietary indicator, is very high at over 90%. Maybe a little bit overbought, but I have seen it at 100% for a while, and and the stocks just continue at higher. So maybe we'll get a little bit of a pullback, and then we'll take another leg higher. Don't think this is anywhere remotely bearish. As far as just regular momentum indicators, here's RSI. It was overbought here in February, and now we pulled back from overbought territory in March. So overbought just means it's very strong, and it means that there was a lot of buying present. So right now it's not even overbought, so maybe investors who were feeling left behind will jump in and continue buying. Long-term percentage of stocks above the 200-day exponential moving average and the bullish percent index are firmly bullish, I think. 70s, 80s. So I don't think there's anything, remotely bearish about stocks right now, especially about the major indices. Here's S&P 500 in the longer term, in the weekly time frame. You can see this pivot point here at 2407. This is a yearly pivot point. We came up to that pivot point. We hit 24, basically 2401, almost touched it, and now we kind of bounced back. Does it mean we're going to stop here? There's no way to tell. We could just continue higher to the second resistance. Additionally, or alternatively, we could pull back. So again, this is a bullish chart, so I would not be looking for top just yet. I don't see any top informations, honestly, on this chart. Here's a Dow Jones Industrial Average. also all-time highs. Additionally, advanced decline line for the Dow uh, also hit all-time highs just on Thursday, and this is a little bit of a bullish divergence here because you can see that uh, the the index pulled back slightly, but the advanced decline line made a fresh all-time high. So this is a little bit of a bullish divergence. And additionally, you can see bullish percent index also moved higher here. So there's a little bit of a bullish divergence. We could actually see fresh breakout by the Dow Jones Industrial Average. Okay, here's QQQ, the strongest of the major ETFs. Just an enormous move, really. Very strong. Again, fresh all-time highs here on Wednesday. My subscribers were buying back here before the November elections, and we still have positions open from back from November. So very strong move in QQQ, and it's still going. Um, and here's a fresh all-time high in a QQQ as well, and here's fresh all-time high in advanced decline lines, also just on Friday. So again, a little bit of a bullish divergence because you can see the index, well, for the past 2 days moved slightly lower, but the advanced decline line hit all-time highs. So far, very strong move, and it's showing no signs of abating. Here's QQQ on a little bit longer term chart. You can see that on RSI here, it's still overbought. So it became overbought and just kind of dipped a little bit into no longer overbought territory and just became overbought again. So this is just showing enormous buying pressure. Investors are really trying to get into QQQ. And next, I'll show a couple of interesting stocks and parts of QQQ that are doing particularly well. So here's that part, which is technology sector, XLK. The composition is slightly different than QQQ, but pretty similar. Also, all-time highs, very strong move, just an enormous move of the November lows. And again, I don't see many signs of it stopping. Also, fresh all-time highs and advanced decline line here. Within QQQ, I wanted to point out semiconductor ETF SMH, also just a tremendous move up as well, all-time highs, all-time closing highs. And so I was wondering what was driving SMH, because this is a little bit of a top-heavy fund, and two stocks are really major components of this SMH is Taiwan Semiconductor and also Intel. And I looked at Intel. Intel didn't look anything like, it's not very strong right now. It kind of pulled back actually. But Taiwan Semiconductor, I looked at it and it's actually at fresh all-time highs. So it's really one of the drivers of SMH, and it's pushing higher as well. So then I looked, I figured, Taiwan Semiconductor is a Taiwanese firm, so let me look at the ETF for Taiwan, and lo and behold, it is also at fresh all-time highs. Taiwan Semiconductor is also one of the major components of this ETF, EWT, and my subscribers are also long EWT, so hopefully we'll continue higher with this one. Here's IWM, the Russell 2000 Small Caps Index. This one is lagging slightly, but I definitely wouldn't call it bearish. So after the November surge, it just kind of traded sideways and we broke out to fresh highs, and now we pulled back. Now this looks to me like a bottoming pattern, so it's possible we'll continue higher from here. This one is a little bit weaker, and also you can see the advanced decline line broke below recent lows, and same goes for advanced decline volume line. So it's a little bit of a bearish divergence. Whether or not this will be worked off, remains to be seen. Some investors say that small cap weakness in the small caps is kind of like a canary in the coal mine, and eventually the entire market will roll over. I have no idea, and I don't think anybody really knows what will happen in the future. But to me, this chart still looks very much bullish, and I would only look to go long. I would definitely avoid shorting it still. Here's some more market breadth indicators for IWM. You can clearly see a higher high here in the index itself, yet you can see a lower highs in momentum indicators and in market breadth indicators as well. Same goes for a longer term market breadth indicator here. This is a percentage of stocks above the 200-day exponential moving average, and you can see it is moving lower. So this is definitely a concern, and this is a clear bearish divergence. You can see here it was 82 in November, and currently in March 2017 it's only at 68 and went as low as 61. So there is a little bit of a bearish divergence, even though you can see that the prices of the IWM are moving higher. So how much of a concern this is remains to be seen. The divergences have a notorious way of not working out, and they just continue higher, especially with stocks. Here is XLY, consumer discretionary. This is probably as economically sensitive as it will get, and you can see that it is at all-time highs just this Friday. So this is showing very strong appetite for risk, in my opinion. There is a little bit of a divergence here. There is a little bit of a bearish divergence, especially with the volume. How much should we worry about? It remains to be seen, because this divergence really came close. We can see this 5909.24 here in February, and it was 5909.98 here in December. So it's not as big of a deal as some of the major divergences from, like, let's say 2003 or from year 2000. So they were pretty obvious back then. This is very mild still. As we move into, here's another one, XLF. This one is a financials, and this one contains a lot of banks. This week the interest rates actually dropped, and this is weighing on banks. In other words, bonds rallied. So financials are under pressure. But it is still very much a bullish chart. Again, maybe we'll correct some, bottom out and continue higher. I would not short it just yet, honestly. And now here are a little bit more defensive sectors. Here's XLV. These are all-time highs just on Wednesday. Again, nothing that I'm concerned about for this chart. That I don't see many concerns for this chart at all. These are all-time highs. This is continued towards all-time highs. So advanced decline lines are confirming so far the move higher. Moving even further towards the defensive part of the market, here's XLP, consumer staples, and this candle is certainly not looking great. This could be like a shooting star and a daily bearish engulfing. So maybe we'll move a little bit lower to, like, maybe to retest this lows here from March lows. But this is still a bullish chart, and advanced decline lines are also at all-time highs. So I certainly, again, would not short it. Okay, here's real estate, and it just completely got demolished the past few weeks, and now it looks to be bottoming. And there was a big surge here on Wednesday when the interest rates decision was announced. Very weird behavior by the bonds when we get there, because even though the federal funds rate increased, bonds also rallied, and usually they move opposite to one another. So maybe there is a defensive posture that is creeping into the stock market, and real estate is certainly more of a defensive ETF. And here's finally another defensive ETF, XLU Utilities. On Wednesday, we hit fresh all-time highs. If you listen to my previous videos, I kept pointing the same thing out, that this is down here, back in November, December, February. This was simple underperformance. This was by no means a bearish indication. Utilities are still stocks. They're utility stocks. They're not utility bonds. I mean, there are utility bonds, but this particular fund, XLU, is composed of utility stocks. And here we have also advanced decline line, advanced decline volume line. They were hitting all-time highs even before utilities hit all-time highs. So in other words, this was a bullish divergence, and now we have fresh all-time highs. In other words, the price has never been here before. These are fresh all-time highs. So to summarize, stocks are bullish. There could be a little bit of a rotation into more of a defensive sectors that is going on. But at the same time, some of the more clearly offensive sectors like technology and the cyclicals, the consumer discretionaries, are also hitting all-time highs. So overall, the market, I think, is very bullish, and most stocks are benefiting from the buying by the investors. All right, let's move on to the bond universe. This is G&K, high yield bonds. Let me go to daily chart first. So here's G&K on a daily chart, and we were at all-time highs just in the beginning of March. Then we sold off relatively hard, but looks like we bottomed out here in March and then surged on Wednesday when the interest rates decision was announced. Now for junk bonds, I sort of understand it because they're basically stocks. Because you can see the correlation coefficient is very high to the general stock market. But when we get to the investment grade ones, I am a little more puzzled. In any case, junk bonds on the weekly time frame, same thing. We had the drop here and now a surge. So the weekly candle is not terribly bullish. I wish there was a close a little bit higher. Then it closed. If it closed like around 36.70, I would say this is definitely a bullish candle. But this one is a little bit, because there was a little bit of selling by the end of the week. But again, you can see that the correlations are very high to the stock market. So I would group the junk bonds together with stocks. Moving on to the investment grade corporates, which are higher on the investment grade ladder. This one is a little bit messy chart, but overall we had a big drop with a gap and a continuation lower. Finally, we bottomed out here in December and rallied, and then pulled back. Now I was watching this pullback level, and we pulled back exactly to the previous breakout level, and this is from December highs. So we broke out, pulled back, another attempt to break out, another pullback to the same area. And now I thought this was a breakout. You can see there was a gap and a fresh high for the move, but then they got stopped here at the 200-day moving average, and we only partially filled the gap from November. And we sort of unraveled from here and moved steeply lower, and even moved below the previous bottoming pattern here. So I thought, now if we continued lower and broke below this lows, I would say pretty, straightforward that we may have entered the bear market. But now looks like, again, see how we moved below the previous support levels, gap down below it, kind of traded for a few days and then surged. You can see big surge with a gap and a surge. So maybe this is a bear trap. Maybe from here we'll just continue higher, close this gap and continue even higher. Because you can see on the LQD on the weekly time frame, I cannot say that this is a bearish chart. This is a bullish chart still, in my opinion. By the way, this is total return. In other words, dividends. This price is adjusted for dividends. So you can see that in 2016 March, we broke out above previous highs from April 2016, continued to fresh all-time highs, and now we simply pulled back. So we pulled back to retest the breakout. Surge of the retest, moved lower, and looks like we're making a higher low. So if we do hold here and continue higher, I have no problem with this chart. This could be still very much a bullish chart. So let's look at TLT. I just closed AGG because they're very similar to LQD. There's really no point going over all of them. TLT, this is a daily chart, more volatile than LQD and AGG, and more volatile than stocks themselves, surprisingly. You can look up the standard deviation for TLT. That's actually higher than S&P 500. In any case, support break here in November with a gap, and they've continued lower to 52-week lows. This is also a total return. In other words, this price is adjusted for dividends. Surge, pullback, surge, pullback, no breakout as opposed to LQD. You can see for LQD there was at least attempt at a breakout right there. For TLT there was no attempt at a breakout. So we got stopped here at the previous highs and then moved back down. Now here again, what was really surprising for me is that the Federal Reserve decided to raise the interest rates, yet bonds on that same day, right there on Wednesday, rallied strongly, more than 1%. This is a long-term TLT. So this was very surprising to me because normally when the interest rates go up, bonds drop. But in this case, it didn't happen. In fact, exactly the opposite happened. And this just shows that you never know what the reaction would be to news. Sometimes the news are excellent, the stock drops, and vice versa. So in this case, the news were terrible for TLT because they're going to raise interest rates, and that would have been terrible for TLT. And if we made fresh 52-week lows, I would have been, it would make perfect sense. But here it didn't. They didn't, and we actually rallied. So to me, this is a warning sign for the general stock market, I think, because bonds are usually a go-to asset class during the times of stress, of financial stress of some sort. So perhaps uh, stocks are overextended, and perhaps bonds are going to be the go-to during the upcoming time of stress. Now, I don't know if this is going to hold here. So this is a weekly TLT chart, also a total return. In other words, the price is adjusted for dividends. These are indeed 52-week lows, so I had an easier time saying that this is a bearish chart. But now I'm not so sure, because you can see that we surged and then pulled back exactly to the support levels, basically from the previous 52-week lows. Did not yet make fresh 52-week lows. So it's possible that this support will hold, and from here we may move higher, and at the very least attempt to close this gap from the November support break. So bonds are proven surprisingly resilient, and I wonder if this is something that we should worry about as far as the stock market goes. All right, let's move on to the Forex universe. This US dollar in a daily time frame. So also the same thing here on Wednesday when the interest rate decision was announced. This was a surprising move in the dollar. It moved lower. And just, let's say if you have a lot of money in Europe and you want to park it somewhere where it will get you some interest rates. So what do you want to do? You want to open a United States account and just transfer some money there, where the money will be giving you some interest rate. It's just a very basic example. So the same thing goes for the uh, larger institutions. It would make sense for the uh, dollar to appreciate when the interest rates are higher here, but exactly the opposite happened again on Wednesday, and this is again a concern for the US dollar. Now, generally speaking, I still think this is a bullish chart because these are multi-year highs. So far, this is a normal orderly pullback from multi-year highs. Whether or not it will turn into something bigger remains to be seen. Maybe this is a head and shoulders right there, and maybe we're building the right shoulder. Maybe when we get to 99, we'll have a support break and then we'll move lower. If this is indeed a head and shoulders, then we can say, okay, so if this is the depth of the height of the pattern rather, so like maybe 4% or so, so we can expect a move lower from here of around 4%. So I'm guessing if we do break this support around 99, then we could probably expect a move down to 95.90 from November lows. It obviously hasn't happened yet, and again, even if that does happen, let's just go to weekly chart. Even if we do not hold 99.19 here, and if let's say we move down to like 96, I still don't think this is going to be a major concern. This would be still like a normal pullback within a bigger uptrend. Now, if we break 91 and like close below 91 here on a weekly basis, that would be a major concern because that would be multi-year lows already. Now we're still very close to multi-year highs. And here is euro versus US dollar, and here is that surge. Actually, let me update this chart. This is still from Thursday. It hasn't been updated for some reason. Oh, still hasn't been updated. But anyways, this surge right here from Wednesday, this is what I'm talking about when the dollar moved lower, and it moved lower against pretty much all major currencies. So for euro versus US dollar, what I see is pretty strong resistance here at around 1085. Why? It's again because there are many things that happened there. So first we had a low right here in October, then we had the support break right here in November. We had an attempt to rally and get up above it, which clearly failed at exactly that same level. Here is exactly that same level acting as resistance in February, and now again this is March and we're attempting to get up there as well. So, and then also the 200-day moving average is going to be around that area as well. So very strong resistance up here at 1085, but if we do punch through it, this could be quite positive for the euro obviously, and by extension negative for the dollar. Here's the weekly time frame for euro versus US dollar. Here's that same level at around 108.5 or so, 109. We could punch through the resistance and then we could continue higher. If we punch through that resistance, we could probably retest the highs from November at around 1.13. It obviously hasn't happened yet, and this is still, in my opinion, a bearish chart of euro versus US dollar. Here's British pound versus US dollar in the weekly time frame. Pretty much similar pattern, and it looks like the pound is moving higher. But overall, this is very much a bearish chart still. And here is US dollar versus Japanese yen, traded oppositely than euro versus US dollar. You have this bullish engulfing pattern here, so you can see those big white candles engulfing the previous candle right there with a follow through, but then looks like we unraveled this week. So maybe that's 111 111.57 area will get retested again. For now, I still think that US dollar versus Japanese yen is bullish. In other words, the dollar is winning this battle. Maybe we'll bottom out here and then finally continue higher. Right, let's move on to gold. And gold is certainly taking advantage of the weaker dollar. So gold became oversold after this few weeks moving lower. We had a few bottoming candles here and finally a surge. So provided dollar doesn't do anything crazy, for example, rally from here strongly and take out the highs here, as long as dollar at least trades sideways and possibly down, gold may take advantage of this and continue higher. Here is a GLD, the retail ETF where you can trade dollar, where you can trade gold. You can see pretty big hollow candlestick here from Wednesday. We had a gap up and follow through next day. So that's good news for gold. Gold investors. At the very least, it's not completely unraveling. But as I show with next several charts, there are still plenty of concerns about gold. Okay, here's gold on a weekly time frame. A couple of weeks ago, we had bearish engulfing pattern, and this is a weekly time frame, by the way. So we had a bearish. So we had the big red candlestick, which completely engulfed the previous one, with a follow through the next week. So this is certainly a confirmed bearish engulfing. How much move down can we expect? It's anybody's guess, but maybe that was it. So maybe this is it already, and now we have actually an inside week for gold. In other words, this week's candlestick is entirely within the previous week's candlestick. So this could be thought as a triangle consolidation. We'll see what happens next week, but usually triangle consolidations are kind of like a strong patterns, and usually a breakout one way or the other follows with a strong move. Again, if the dollar decides to move lower, then we could see a breakout of this consolidation higher. That is also possible. Here are the gold miners, and of course they are much more volatile. GDX, this is a daily time frame. So GDX became quite strongly oversold, if not, I would say this was extremely oversold. Right here in beginning of March, and then we had several attempts to bottom. Finally we bottomed, and then we had a strong surge here on Wednesday, very big white candlestick. On Thursday we had a follow through, but it again got stopped at the 50-day moving average, and Friday we just sort of meandered sideways to slightly down. So I still think that this could be like a weekly a bullish chart, I guess is the word. We could still see a move higher for gold and gold miners, again provided the dollar doesn't decide to rally from here. So let me just take a look at the market breadth. Unfortunately, it's still from the 16th, but you can see that there was of course, as the prices moved lower, the market breadth, advanced decline line, advanced decline volume also moved lower, and also the bullish percent index. The bullish percent index also moved lower. So that makes perfect sense. What concerns me on this chart is that we have new lows that are appearing within the index. So for now, I would still treat this chart as bullish. if we get up here to 25.70, $25.80 area, this would be a major test of resilience of gold bulls. If we punch through this resistance, this could be a very good sign. Next chart, what I wanted to show is this is also a chart of GDX, and on it I have a bunch of my proprietary market breadth indicators. Now, okay, gold breadth index, GBI, this is a very long term, and this is a composite of all of the inputs. Technically, it's still bullish. So I am not looking to short this chart just yet. Intermediate term, this is a percentage of stocks on the buy signal. We became bearish. This was a bearish trigger back in October, and since then, despite pretty strong rallies, we were still not able to get above 90. I need to see a move about 90, and we came very close here in February, and this was a very strong move, and still we were not able to get above 90. So I am still treating this indicator as bearish. So percentage of stocks within the index and the buy signal did not yet get up above 90. It could, it could happen, but it didn't happen just yet. So for now, we'll see where this goes. Now, this is where my major concern is, and this is a like a raw input for the market breadth index for gold. It actually got worse here around beginning of March, and additionally, knowing from the experience, this is going to get worse next week. So I think it will drop to like 37 or so percent. So the bearish trigger for this indicator is 20. So if we get below 20, then we'll have all of the inputs for the total market breadth index showing a bearish posture. Right now, it is still a weekly bullish chart. So at MasterChartsTrading.com, we do trade this, and last time we traded, we had about as much as 37% gain, depending on where you entered. Finally, the reason why I say this was an extremely oversold case, in other words, this low here in March was quite an extreme level. Another experimental indicator, this is a ITBM, intermediate term breadth momentum oscillator. You can look up what it is on StockCharts.com. It's just a calculation. But this was a very oversold level right here at minus 10 or so. So to summarize, uh, gold miners are, I would say, they're weekly bullish, but we need to see some of those levels taken out to the upside, so that all of these concerns about market breadth, etc., will finally go away, and this most likely will depend on United States dollar. And moving on to the hard commodities, here's West Texas Intermediate light crude oil on a daily time frame. So back here in December we had 52-week highs, and I was not 100% on this 52-week highs. I kept thinking that this was an oversold bounce, and it took oil prices all the way to 52-week highs. This was a bearish candle, very bearish candle, and we went ahead, and I myself opened a position in the inverse crude oil in March here. So we're basically riding this entire leg down. Now we are getting a bit of a bounce here. So far, I don't see this bounce going above the support break, and I'm going to say that this is previous support. So far I don't see it going above it. It's possible it will go higher, but honestly I still think this is a bearish chart, and there are multiple reasons for oil to be bearish. The most important one, of course, is because there is a glut of oil. There is a lot of new rigs coming into online. There is OPEC is trying to cut production, and the United States is actually trying to ramp up production. So it makes very little sense for oil to be going higher. So here is a weekly time frame, and this was indeed a very long and also extremely frustrating sideways chop. So neither the bulls nor the bears were able to make any money in this chop here for 12 weeks, basically 3 months. Finally, we had a big breakdown, and I think we may see lower prices ahead. My best guess is that we at least will retest the November lows here at around $42, possibly lower at around $39. Alternatively, something could also happen, for example, oil supply disruption, and we could skyrocket from here. But how much can we skyrocket, I wonder, because there's just so much production in the United States that is actually idle. So United States production can increase dramatically. Here's XLE, the energy ETF. And this was one of the reasons why I was quite wary of going long, buying energy and buying oil. Yes, these were indeed 52-week highs, but then basically we've been selling off since then. Additionally, the market breadth did not confirm this highs. You can see advanced decline line did not make all-time highs or even 52-week highs. The volume, advanced decline volume, did make 52-week highs. Now we have a little bit of a bearish divergence here. So here in November, advanced decline was 277, this level here, and this level here in March. Even though you can see that it is higher, advanced decline already is making lower lows, and same goes for advanced decline volume line. So energy and oil obviously are related because there's a lot of oil production companies in XLE. Here's another longer term time frame chart for XLE. Back here in 2015, you can see oil was consolidating sideways, but energy was selling off already. So it was like a tell for oil prices. Finally, oil prices caught up and started selling like there was no tomorrow. In fact, we got as low as $26 or so here in February of 2016. Pretty much the same thing I'm seeing right now. I see oil prices that, or rather energy ETF XLE started dropping here back in December, while oil itself is trading sideways. And then finally oil seems to be catching up to energy ETF. So maybe everything, energy and oil will continue lower now together. It's also possible. All right, and here's natural gas on the daily time frame. Very volatile security. Be careful trading it. So these are 52-week highs here, just beginning or the end of 2016. After that, we kind of moved lower, strongly lower, and now I thought that this was it. I thought we bottomed out here in February and then surged. So now we're again moving lower, and now I wonder if we may actually come down and retest this breakout level at $2.50. Now this breakout level is more clearly seen on a weekly time frame, and here's that weekly time frame. So looks like we had a breakout in June, July of last year, right there, breakout, 52-week highs, throwback, fresh 52-week highs, another throwback, another 52-week highs. Now looks like we're unraveling again, and possibly we're gonna retest this 52-week low, 52-week I meant to say a breakout again. So this is a volatile security, so be extra careful trading it. Honestly, I discourage new traders from trading it altogether. If you like what you're hearing, please do like this video. If you have any comments, don't hesitate to comment, or if you have any questions, you can send them in to MasterChartsTrading.com. And of course, share this video and this post with others who may benefit from it. Again, thanks for watching, and please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.